I'm Komal and welcome to HP Wealth Insights, an initiative to simplify investing by HP Private Wealth Advisory. Debt funds are often considered safer options, but when used tactfully, they can be smarter too. Debt funds can offer better returns than FDs or savings accounts, help manage risk during equity market volatility, or can even serve as an efficient parking tool while you wait to invest. So, say for instance, you have set aside some savings for an upcoming payment, say school fees coming up in 6 months. A liquid or an ultra short fund might be able to offer better returns than parking the same fund within savings account or a similar term deposit without taking substantial risk. We'll look at such more strategies later in the video. But first, let's understand the foundation. The 16 categories of debt mutual funds as defined by SEBI. Let's decode Group 2 debt funds utilizing 3 lenses. Lens 1 duration, Lens 2 strategy, and Lens 3 credit quality. Duration-based debt funds refer to how long underlying securities will take to mature. Or, in other words, it's the term of your investment. SEBI has defined 9 categories based on maturity, ranging from 1 day to more than 7 years. Overnight fund. As the name suggests, this fund invests in securities that mature in 1 day. It's one of the most conservative category, ideal for parking temporary funds with virtually no risk, typically utilized by corporates, institutions, and even retail investors with substantial cash holdings looking to earn better returns rather than simply parking the same money in a savings or a current account, even if it's just for a day. Liquid funds invest in instruments that mature up to 91 days. They are low risk, highly liquid, and widely used for parking emergency funds or temporarily parking during market uncertainty. Commonly used by retail investors and high net worth individuals, and those looking for quick access with better returns than savings account. Ultra short duration fund holds securities that mature in 3 to 6 months time. They offer slightly higher returns than liquid funds while maintaining low volatility, typically utilized by investors who are planning short-term expenses like insurance premiums, school fees, or payments scheduled in near future. With low duration funds, maturity ranges from 6 to 12 months, offers a bit more yield than ultra short fund while still being relatively stable. Commonly used by investors for upcoming medium-term payments, such as buying a vehicle, funding a wedding expense, or preparing for annual business payments. Money market funds only invest in money market instruments maturing within a year. They are conservative, low volatility options, typically utilized by risk-averse investors keen on earning higher than what savings account could offer, and especially useful for treasury management. Short duration funds invest in bonds maturing between 1 to 3 years. They balance safety with potential returns. An excellent fit for investors planning for goals within 2 to 3 years, like a planned vacation, home renovation, building a buffer for higher education. Medium duration fund invest in bonds maturing in 3 to 4 years. Slightly higher return potential, but also more sensitive to interest rate changes. Best suited for investors with the time horizon of 3 to 4 years and who can tolerate a little bit of volatility. A perfect example would be to save for pre-university fees. Medium to long duration funds hold bonds maturing in 4 to 7 years. They carry duration risk but also a potential to earn higher, often used by long-term savers or experienced investors who can tolerate short-term volatility, such as those planning for second home or planning for a business expansion. Long duration fund invest in bonds maturing in 7 years and over. They are highly sensitive to interest rate movements. They can deliver strong results in a rising interest market, and contrary to it, when interest rates are to fall, they can experience volatility. Best suited for investors who understand macroeconomic trends and are comfortable with interest rate movements and can leverage out of this knowledge over long term. Now that wraps up our first lens, duration. As you would have seen, choosing the right fund directly depends upon the duration that you can invest for or the time horizon that you have for the investment. Now, let's explore Lens 2, strategy-based debt funds, where fund managers have more flexibility in how they can respond to market movements. These funds focus on how a fund manager navigates between interest rate movements and economic conditions. This category provides more flexibility to fund managers to adjust their portfolio in line with market outlook. SEBI has defined 4 categories in this approach. Dynamic bond fund, just like its name, has the most flexibility. A dynamic bond fund allows the fund manager to actively change portfolio's duration depending on interest rate environment. For instance, if interest rates are expected to fall, the fund manager may shift to long duration bonds. And contrary to it, if interest rates are expected to rise, then they may shorten the duration of portfolio to reduce the risk. Typically utilized by investors who do not want to time interest rate cycles on their own, but are comfortable with short-term movements and can trust fund managers' active strategy. A Gilt Fund invests at least 80% of its portfolio in government securities, meaning there is virtually no credit risk. However, they are still sensitive to interest rate movements, performing well when interest rates fall and decline when interest rates rise. Often utilized by long-term investors and institutions who want high-quality government-backed exposure without the risk of corporate defaults. This is a specialized Gilt Fund that holds government securities for a fixed duration of 10 years. It's highly sensitive to interest rate movements, but that sensitivity is intentional. These funds can generate solid returns in declining interest rate environment. Typically utilized by macro-aware investors or high net worth individuals who want to take directional calls on interest rates, either for diversification or tactical positioning. A floater fund invests at least 65% in floating rate instruments, bonds where the interest paid adjusts with market rates. These funds tend to benefit from increasing interest rates because the coupon resets upwards. Commonly used by conservative investors, treasury teams, or anyone who wants to protect their capital from rising interest rate risk while continuing to earn market-linked returns. That's the wrap-up of strategy-based debt funds. Ideally, for individuals who would want to adapt their debt portfolio to changing interest rate cycles and changing economic cycles. Lens 3, credit quality. These funds focus on who your money is lent to. SEBI has defined two categories based on credit quality. Corporate bond fund invests at least 80% and over in corporate bonds with rating of AA plus and above. They are high quality and relatively safe. These funds aim to provide predictable income with minimal credit risk, typically utilized by conservative investors, retirees, or those looking for steady, low-risk returns. Similar to fixed deposits, but with better tax efficiency if held over 3 years. A credit risk fund is quite different. It invests at least 65% in low-rated corporate bonds, typically lower than AA. These bonds offer higher yields but come with higher credit risks, meaning there is greater chance of default and credit downgrades, generally preferred by investors with high to aggressive risk profile who prioritize risk, return, and opportunity over safety. So with this lens, we conclude that investing in debt fund is just not about duration and strategy, but it is also about credit quality, who you're trusting your invested money with. Let's get to the most exciting part of this video. Let's quickly recap and help you decide which fund might potentially be right in your situation. Please note, this is for guidance only, it's not an advice. Duration funds, if you have a clear duration in your mind, just like FDs, the longer the time frame, the better the returns are. Planning for 3 months? Consider liquid or ultra short duration funds. Saving for 2 to 3 years? Look for short or medium duration funds. Thinking long term and can handle volatility? Long duration or Gilt Fund may work. Or you're after the strategy, dynamic, gilt and floater funds might be right for you. If you're expecting interest rates to rise, utilize floater funds. And if you wanted to count on the expertise of fund manager, then consider dynamic fund. And don't forget to check the credit worthiness. If you're looking for stability with low risk, consider corporate bond funds. But remember, for any investment, it's critical to understand your risk profile or risk appetite. Now let's summarize why debt funds could be a smarter choice. In most instances, they provide better returns than fixed deposits or savings account or current account without having to invest in equities. They are flexible, which means they are open-ended, which means that they don't have lock-in, which means that in most instances you can withdraw your money anytime. They are tax efficient, which means that if you invested for longer than 3 years, you can apply indexation benefit, providing you better post-tax return. And as explained in this video, there are 16 various debt funds to either choose as a standalone or to mix and match to complement your goals and objectives. Interesting, right? Why not connect with a SEBI Registered Investment Adviser who can coach you and guide you in not only selecting the right fund for you, but in tactfully utilizing these instruments and designing a sequence to maximize your investments over time.